Hello, welcome to Business Playbook TV. On this series, the best and brightest business leaders and professionals share their unique insights and update us on current trends in business. As our expert commentators and on-air correspondents, they report for our departments: Business Finance Playbook, Networking Gurus, The Coach's Corner, Marketing Madness, Tech Talk, Sidestepping the Legal Minefield, and CPA Secrets. Today, I'm happy to introduce you to several of our correspondents, two of them being here on set with me. First of all, we have Fernando Coates, who is a partner in the firm Gleason Coates.
Good day.
Good to have you. And then we have Mark Dunlop, who is with Bank United. Mark has been some other shows with us, and we're very glad to have you back.
Thank you for having me.
I'm going to start with you. So, part of what we talk about here are, relatively new businesses. Okay, not always, but there's a good share of what we talk about are those. And capital for new businesses is tight. They have to be careful how they stretch their dollars, and so they tend to overlook certain things that they really shouldn't be overlooking. Mm-hmm. And so, one of the things I wanted to talk to you about that was exactly that issue. Where it comes up is, I think, in cross-purchase agreements.
That's right, and in stock redemption.
Stock redemption agreements as well. So let's talk about the cross-purchase agreements.
Well, the cross-purchase agreement, what it basically does, it protects the initial shareholders of a company. In other words, they want to make sure, the initial shareholders, investors, that their shares remain with those people who started the company. And it's a way of maintaining a privacy and control of the company. So when one shareholder wants to become liquid and get out of the company, that shareholder will be bound by an agreement in which the other shareholders may and can purchase those shares. There can be certain exceptions for a spouse or family member. It depends on the agreement. So
companies that are starting out, sometimes they don't have those. What can be the consequences of that?
Well, the consequence can be that if they don't have a cross-purchase agreement, one of the advantages, it's a tax advantage, is that when the cross-purchase occurs, there's a stepped-up basis on the shares that are purchased. So the shareholders run the risk of not only losing control, but being at a disadvantage in terms of taxes.
Plus, you may become partners with a spouse.
Or a third party, which is even more problematical, a stranger, if you will, someone who has nothing to do with the company, was not there from the beginning.
So how would you become partners with a third party? How would that happen?
If there's no cross-purchase agreement, which is the one way to prevent that, with the exception of a spouse or a family member.
What more do you want to tell us about cross-purchase agreements?
The thing I'd like to really address is, as well, as the stock redemption agreement, which is the alternative for a company to maintain control. And in that scenario, it's a tool, so to speak. The company can maintain control of the shareholder structure itself, making sure that the people who own the company are the ones, from the beginning, remain owners. They can remain private. It's a manner to prevent any hostile takeovers, and it's a way of returning liquidity to the investors, the original ones.
So how does a stock redemption agreement work?
It basically, as I said, it protects the company. It's an agreement in which the company itself can buy back the shares at a call price. Okay. Sometimes. These agreements are flexible, and at a certain time when the original investor or shareholder wants to get out of the company.
I've heard of cases where a partner in a business, a shareholder in the business, has an injury, stroke, things like that. How does that impact either a cross-purchase agreement or a stock redemption agreement?
Well, a well-crafted agreement will take into account certain triggers, if you will, such as death, disability, and so forth, and it'll transmit or permit certain transfers to occur as a result, because the company wants to maintain control, or in the case of the cross-purchase, the original investors want to maintain their own control.
I'm guessing that redemption agreements don't really require disability insurance. Would that be true?
That's a separate issue. The stock redemption is really about the company returning stock to itself. A disability and those kind of agreements really go to a shareholders agreement, which is another tool the company can have.
What happens to the basis of the stock in a stock redemption agreement?
It's not the same as in a cross purchase. There is no stepped up basis, so there is a disadvantage, but it's the company itself that's that's taking back the stock, becoming treasury stock, and at the same time, the original investor gets back its capital.
We started this conversation by saying that early stage companies, because they save capital, they don't like to spend money on things like legal fees. What are some of the other areas that they should be thinking about in terms of agreements that maybe they don't when they start their business?
Well, as I said before, I believe a shareholders agreement is essential, especially for a small company, because it will take account the aspects of, it can take into account the aspects of a cross-purchase agreement, stock redemption, and of course what happens with respect to someone, an original shareholder or subsequent one who passes away or there is disability and they can't continue. And what happens to those shares? Do they go to the estate or do they go back to the company or to the other shareholders?
I'm going to ask this question of both you and Mark. Covenants in agreements. What happens if a covenant is broken, and what are the most important covenants in a loan agreement?
Well, for us, breaking a covenant can make the loan be called.
Okay.
In the small business space, and we're talking about businesses that make less than $10 million in revenue a year, we try to avoid covenants at Bank United. But the common covenants would be things like annual financial statements or quarterly financial statements, or changes of ownership, things that can trigger certain events. But we try to keep the small business deals a lot more streamlined and simple than that.
Okay, and Fernando, when you're drafting or reviewing these kinds of loan agreements, what are you looking for when it comes to the covenant issues?
Well, what I look for are basically three kinds of covenants: the financial covenants, the affirmative, and the negative covenants. And I try to counsel my clients to say, be careful, because these are, as has just been said, are triggers for foreclosure. And the bank is trying to protect itself. It's understandable because they may not have property, which could be the collateral, is the company itself. So I tell them, if there, for example, a negative covenant is no change in the capital structure, for example, selling the shares to another company that takes over. That's an essential element that they must be aware of. And if they contemplate it, I say you have to, I counsel, advise the bank, otherwise there'll be a trigger for foreclosure.
Okay. Have you actually had to get involved in dealing with this issue of broken covenants?
Yes, I have. And it happens usually because the client hasn't told me what's going on. Then they come to me and there's an issue with the bank, and we have to try to hopefully negotiate some kind of settlement.
How often are you successful in that?
It depends on the loan structure and how willing the bank is to be flexible.
Okay. How do people find you?
How they find me, it's basically I'm a business lawyer, and therefore what I do is counsel companies, especially small companies, startups, medium-sized, and my name is out there, which I'm grateful. Hopefully it's a good name.
Okay. So now that you're a correspondent on this show, we'll be expecting to see you come in often with us. Thank you.
Thank you.
Thanks for being with us. Mark.
Yes, sir.
Tell us about what is the state of lending in early 2019?
Lending is vigorous right now.
Okay.
There are a lot of deals to do. There's a lot of competition for those deals. More competition probably than I've personally seen in the last couple of years. Banks have money to lend or are eager to lend it.
What kinds of deals are you seeing?
I try to focus primarily on operating companies with revenues below $10 million. And we end up doing a lot of owner-occupied commercial real estate deals. So if someone's been leasing a property for the last 3 or 4 years, decides they want to own it, we give them a mortgage to finance that transaction. We also find ourselves doing a lot of credit lines to support working capital, seasonal credit lines, that type of thing, and equipment financing.
Red tide has actually had quite an impact in this market, where we are in southern Florida. Have you been involved in some of these loans as bailouts for some of the businesses here, like seasonal loans or red tide loans, things like that?
We really haven't. The SBA has offered some programs to help folks out. I think their success is somewhat spotty because they're coming to businesses when they've already suffered a pretty dramatic downturn, and then taking on more debt, and they're in some vulnerable industries where getting out of that debt is going to be a problem down the road. But for some people, they're going to serve a good need, but we just really haven't seen a whole lot of requests for it.
Have you been doing any SBA financing?
We do quite a bit of SBA financing. Okay. Yes, we do.
Tell us about that.
So the most common programs for us are the 7A program and the 504 program. Now, a lot of people think that those are for startup businesses. The challenge
Can
for
you describe the difference between a 7A and what is the other one?
504.
Okay.
We typically do 7As for operating businesses, and we typically do 504s for real estate purchases. So the 7A is the most common one that we see. A lot of people believe that those are for startup or early phase businesses. The thing to keep in mind is that the SBA doesn't lend money. The SBA provides programs that banks can opt into. So we use the 7A program, but we still have to maintain our current underwriting guidelines. So we're going to require to see 2 years, 3 years of tax returns, which eliminates startups. So we do quite a bit of that business, but it's not in the startup space.
So we'll get back to SBA and lending in a second. As we were talking about startups, other than family and friends rounds, which we can talk about, to get that initial capital going, what do early stage businesses do?
That's an interesting question. You know, I end up financing a lot of businesses that have been around for 3 or 4 years, and I'm always curious how they got through that first 2 to 3 to 4 years. And family and friends are certainly a key. That's one way that it happens. But there's a lot of pitfalls in that, a lot of family strained relationships that can come from that. A common one that I see is someone using the equity of their home. So they go to a retail bank, they get a home equity line that they can then use to fund a new business. We've also seen recently quite a few people using their IRAs to do a rollover for business startup. Now that's got a lot of complexity to it, and we always advise people to go talk to their financial advisors before doing that. There are serious,
as well, right?
Yes, absolutely. So we tell them to get all kinds of advice before they go down that route, but it is available for folks that want to draw out $50,000 or more. We do see occasionally some movement in the venture capital and angel capital space, but again, venture capitalists are looking for something very specific and something that's going to scale up quickly, and you're going to give up ownership. There's really no way around that. Probably the most common I see is people using credit cards to fund their businesses up for the first year or two. And what I try to advise people of when they're going down that road is try to keep a designated card for your business expenses and keep a good record of those business expenses. Because when you do get to your 3-year mark or someplace in there where you are profitable, it's possible for a bank like ours to come in and refinance that into a fixed rate loan on your business, but I need to be able to verify that all those expenses were business expenses.
That makes sense, sure. So getting back to the SBA, are there minority-owned business breaks in terms of either getting SBA financing or straight bank financing?
We don't typically see it as an advantage. Our charter and federal regulations require us to serve the underserved communities in our market. So we actively seek out minority-owned businesses and those opportunities. Okay. Where it becomes an advantage really is in government contracting, and certain large corporations will benefit or prefer minority-owned businesses to contract with them. So sometimes there are programs that will give them advantages over other companies.
When that comes into play, if they're getting contracts from the government, that must improve their bankability as well.
Oh, absolutely. Yes? Sure. Yes.
Even though the governments sometimes take 180 days or more to pay?
We try to keep that in mind when we're looking at cash flow and figure out the quality of their receivables isn't always just based on how long it takes to collect.
Okay, so you know ultimately they're going to get paid?
Yes.
Okay.
Yes.
Personal guarantees. Tell us about those.
Personal guarantees are always required in the small business lending space. Right. A couple of reasons for that. Number one, S corps, sole proprietorships, some small C corps don't exist without the underlying owner. That is really the strength. And so we do our cash flow analysis and we judge the capacity and the character of the underlying owners. They have to sign on the dotted line because without them, the company just does not exist as an ongoing concern.
Sure, makes sense. Well, I think we had a really good conversation to help some of these businesses. Before we break, first of all, how do people reach you?
You can reach me via email at mdunlop@bankunited.com or via cell phone 941-524-3285.
Before we break with you two fellows, tell us, is there anything else that you'd like to emphasize more or something that you might like to add?
Well, I would just like to add that with respect to the small companies that are starting up, it's important that agreements are placed that are well crafted and well negotiated.
Okay. Mark?
I would love to add the fact that I get a lot of calls from financial advisors asking me how to access capital for their small companies. Now, these aren't startups necessarily, but for their small companies. And there's an assumption that the SBA must be the right answer to that. We have a tremendous program at Bank United that will fund companies that have been in business for 2 to 3 years, that have $150,000 in top line revenue, and we can get them term loans or credit lines, $25,000 to $50,000, with very little documentation. So we've had a lot of success with that. And typically, as I said, those conversations start with, I'd like to talk to you about an SBA loan. However, there are lower cost, more beneficial programs outside of the SBA through our bank.
Hopefully you'll hear from some people that are watching our show.
Good.
Next, I would like to introduce you to Rania Sedhom of the Sedhom Law Group. She's going to discuss sexual harassment in the workplace. Hello, Rania.
Thank you for having me here, Bruce.
With the Me Too movement, I've spoken with a lot of men who have become paranoid about the situation. Should they be?
Well, I don't think anyone should be paranoid, and I hope that most men are not worried because they're behaving appropriately in the workplace. But essentially, if those men are treating women with respect, like they would perhaps a sister or another family member, there's really no need for them to worry at all.
What are the legal realities and how can exposure be mitigated?
Well, companies must provide every employee with sexual harassment training. This does really two things. For those employees who may be struggling with understanding what is and what isn't sexual harassment or, bad behavior which can result in a lawsuit, they'll receive information that can help them understand it. For women who believe, or men, sexual harassment is not just, against women. It does happen to men as well. But for those individuals who feel like they were victims of sexual harassment or inappropriate behavior in the workplace, it also helps them understand what their rights are, and again, what is and what isn't sexual harassment. So that's the first step everyone should take. The next step someone should take is to perhaps pause before saying something if they're not 100% certain that what they're saying won't be offensive.
People coming to the U.S. from other countries bring different sets of values as it relates to this issue. Can you comment on that?
Yes, that's actually a great question, and this arises often. Many times I find myself having culture questions or culture conversations with my clients. It is true that relationships vary depending on where you're from and the type of environment that you're used to. But when you're doing business here, you need to acclimate to the laws of the country and the state that you're in. And that's why I mentioned training before. It really helps bridge the gap on both sides. So for example, if there's a culture that allows people to hug often, right? There could be a very friendly culture that thinks that's fine. It would be beneficial for that person to realize that they shouldn't just go around hugging their colleagues here in New York and around the United States. So you can speak about the cultural differences and also set a tone, because if the behavior is not offensive, you don't have anything to worry about.
What are the most important steps other than training that companies should take?
Thanks for asking that question, Bruce. That is probably one of the most important questions you've asked today, and that is to appropriately conduct the investigation when someone complains of sexual harassment. Now, sometimes my clients will call me and they'll say, "Oh, we promised the victim that we're going to keep everything confidential." It's difficult to say that to somebody because you at least have to speak with the accuser, right? The accuser and the accused are both going to be questioned. So confidentiality is probably not going to be possible, but you can ensure that the least number of people possible will be spoken to about the event or events in question. So one, keep it close-knit. Ask only those who you need to ask about the incident. Two, be very neutral when investigating. We're all people, and sometimes we believe one person over another because of previous incidents, maybe, their work ethic or how long they've been with the company, or whether or not you've developed some kind of, friendship with your employee. But when you are investigating sexual harassment, it is very important to maintain your neutrality so you can get to the bottom of the matter and correct bad acts.
Does the size of the company matter as it relates to sexual harassment?
It does when it comes to paying damages. As you can imagine, if it's a larger company, people will think that they can afford to pay more in damages, and they'll likely be asked to pay more in damages. Another thing that matters is also the venue or the law under which the lawyer is bringing forward the suit. So, for example, if it's a federal case, there are caps on the damages that one can receive based upon the size of the employer. But on the city level in New York, for example, the New York City Commission on Human Rights, there is no cap regardless of size. But looking at it from a practical perspective, if the company is smaller and the revenue is less, there's only so much money that you would be able to actually collect, regardless of your damages.
How do you know if you're being set up for a sexual harassment charge?
Well, that's a loaded question, Bruce. I don't know how you can tell whether you're being set up. I don't think there are any specific points that I can give to people. But if you treat everyone with integrity and respect, you won't have to worry about what the intention of the other person is, because in sexual harassment, it's either you've inappropriately touched them or you're making sexually explicit remarks. And in the workplace, I don't know why either of those things would happen and how you would be, baited into that. Perhaps you should be careful if you are planning to have a relationship with someone with whom you work. Obviously, people find love where they can, but when that love goes south in the workplace, it can turn quite ugly.
I've heard the term love contracts. What are those?
You have to leave it to lawyers to think of a contract for everything, right? This is what we love doing. Well, a love contract is a contract that's signed by two individuals who work together that essentially states that they're in a relationship, sexual in nature, that it's voluntary, and that they're letting the company know, and they're giving the company an opportunity whenever the company sees fit to transfer one of those two parties to another department or to another area. If it's a small company, they may not have multiple departments per se, so that they're not working, in tandem in the workplace. And a lot of companies use the contracts and find it beneficial. By the same token, some people are worried about the contracts because you can be in a consensual relationship now, you can break up, and then some time elapses or no time elapses, and one of the parties is determined to go on multiple dates with the same person afterwards. And that becomes sexual harassment.
Rania, how can people reach out to you?
You can call me at 212-549-1819.
That's been our show. Thank you for watching Business Playbook TV. We hope to see you during our next episode.